There are days in markets when the scoreboard lies. You look at one stock and it is up strongly, you look at another and it is being punished, you look at the headlines and they all sound emotional. One company is celebrated, another is thrown away, one stock is treated as if the future is obvious, another is treated as if the thesis is broken. But the deeper investor has to do something different. He has to separate price action from business reality. That is what I want to do here. There are times when a stock falling after earnings means the business really has a problem. There are other times when the stock is simply digesting expectations, short-term positioning, or a market that did not like. One line item even while the long-term machine is getting stronger. The difference matters, because the biggest money is often made when the market reacts to one quarter and the long-term compounding machine is still intact. Right now, we are in one of those moments. It is a busy moment for investors because several major companies reported results at the same time. Some of them showed great strength, some showed real warning signs, some showed why AI capital spending is becoming both the opportunity and the risk of this cycle. And one company, in my view, showed the kind of long-term potential that the market may be badly underestimating after a sharp post. Earnings decline, that company is SoFi. But before I get there, we need to understand the broader setup because SoFi is not being evaluated in a vacuum. It is being evaluated in a market where capital is rotating through AI, cloud infrastructure, chips, financial technology, and long-term growth stories. If you do not understand where the money is flowing, you will misunderstand why some stocks deserve higher conviction and others deserve caution. Start with AMD. AMD has been showing strength again. The stock has been moving higher. That is not random. AMD is sitting in the middle of one of the most important capital expenditure cycles in the market. The biggest technology companies are spending enormous sums on AI infrastructure, cloud capacity, memory, chips, accelerators, and compute. When the largest companies in the world increase capital spending, the money does not disappear. It goes somewhere, it goes to NVIDIA. It goes to AMD, it goes to Micron, it goes to companies that provide the chips, memory, and infrastructure required for this AI build-out. This is one of the most important principles in investing. When one group spends, another group receives. Most investors look at the company doing the spending and ask whether the spending is good or bad for that company. A better investor asks both questions. Is the spending good for the company spending it? And who is receiving the money right now? The receivers are in a very powerful position. That is why AMD has been strong. That is why NVIDIA has been strong. That is why Micron is in such an interesting setup. The AI infrastructure cycle is not only a story about software, it is a physical spending cycle. Compute has to be bought, memory has to be bought, data centers have to be built, chips have to be installed, cloud capacity has to expand. And when Microsoft, Amazon, Google, and Meta all increase spending, the sellers of that infrastructure benefit. That is the short-term read through. But not every company spending heavily deserves the same interpretation. That is where Meta becomes important. Meta reported very strong revenue growth. Revenue grew 33% year over year. For a company of Meta's size, that is an extraordinary number. In fact, among the largest technology companies, Meta's revenue growth was one of the strongest. A business with billions of users growing revenue at that rate is still a powerful business. But investing is not only about revenue growth, it is about the relationship between revenue growth and expense growth. That is where Meta's quarter becomes much less clean. Cost of revenue grew 35%. Research and development grew 46%. Total costs and expenses grew 35%. Income from operations grew 30%. That means expenses grew faster than revenue, and operating income grew slower than revenue. This is the opposite of what you want to see from a business with operating leverage. In a healthy scaling business, revenue growth should flow through to operating income at an even faster rate. If revenue grows 33%, you would prefer to see operating income grow 35, 40, or 50%. That means the business is gaining leverage. It means the fixed cost base is being spread across more revenue. It means the machine is becoming more profitable. As it gets larger, Meta did not show that. Meta showed strong revenue growth, but expenses are beginning to absorb the benefit. The headline earnings look better than the underlying income statement because of a tax benefit. Net income and earnings per share looked very strong, but a major one, time tax benefit, helped the numbers. That is why I would not treat the reported net income growth as the true core signal. The core signal is that Meta spending is getting out of hand. This is not a small issue. It is not just one quarter. It is not only an accounting line. Meta's AI capital expenditure plan is becoming enormous. The company raised its capital spending outlook again into a range of roughly $125 to $145 billion for the year. That is an extraordinary number, and the problem is not that Meta is spending on AI. A company like Meta must spend on AI. The problem is that investors do not have a clear enough line of sight into why spending has to rise this much, this quickly, and whether the incremental revenue and profit justify it. That is the key difference between necessary investment and undisciplined spending. Every large technology company must invest for the AI future. But not every dollar of AI spend creates the same clarity with Meta. The question is, why this much is the company spending this aggressively? Because it must just to protect existing revenue. Is it spending because new AI products will generate enormous incremental revenue? Is it spending because management is afraid of missing the AI platform shift? Is it spending because Zuckerberg is willing to accept years of margin pressure for a future that Wall Street cannot yet see? The market does not have the answer. And when the market does not have the answer, the stock can be punished. There is another warning sign. Daily active people were 3.56 billion, up 4% from the prior year but down from the most recent quarter. Wall Street expected 3.62 billion. Meta gave explanations tied to Iran and restrictions on WhatsApp access in Russia, and those may be legitimate, but the direction still matters. For a company at Meta's scale, user growth is already hard. You do not want to see daily active people moving down sequentially. Stagnation is acceptable at this size. Slight growth is better. A decline is not what you want to see, even if the explanation is temporary. So Meta's situation is this. The core business is still huge. Revenue growth is strong. The company remains one of the most important advertising and social platforms in the world. Zuckerberg has a history of being doubted and then coming through. But the spending is now so aggressive that the stock may need to experience pain before the company becomes more disciplined. That has happened before. In 2022, Meta's stock fell dramatically. Spending was questioned. Reality Labs and metaverse investments were criticized. Eventually, Zuckerberg shifted into a year of efficiency, cut costs, improved profitability, and the stock recovered enormously. That history matters because it shows two things. First, Zuckerberg can go too far. Second, Zuckerberg can correct course when the stock and market pressure becomes severe enough. That is why Meta can still work long-term while being messy in the short. And medium-term, a business can be great and still be a poor term setup if spending pressure overwhelms operating leverage. That is the situation I see. Meta may come through in the end, but the path can be ugly. The stock could fall significantly if investors lose confidence in the CapEx trajectory. A move down to much lower levels is possible, not because the company is broken, but because expectations and expenses have become dangerous. This is why I would not ignore the risk. Now compare Meta with Amazon. Amazon also spends heavily, but the market reaction is different because Amazon can show investors exactly where the money is going and why it matters. Amazon reported an excellent income statement. Total net sales grew 17% year over year. Cost of sales grew 14%. Fulfillment grew 11%. Sales and marketing grew only 6%. General and administrative expenses actually fell 2%. Total operating expenses grew 15%, while net sales grew 17%. Operating income grew 30%. This is what investors want to see. Revenue grows. Expenses grow slower. Operating income grows faster than revenue. That is business model leverage. Amazon also beat Wall Street expectations by a meaningful amount. Earnings per share came in far above expectations. Revenue beat by several $billion. But the most important number was AWS. AWS revenue came in around $37.6 billion, growing 28% year over year. Wall Street expected growth closer to 26%. That means AWS is accelerating and remains the most important profit engine in Amazon's story. This is why Amazon can get away with heavy capital spending. The company can point to a specific business line and say, this is where the demand is, this is where the customers are, this is why we have to spend. AWS is a clear receiver of AI and cloud demand. If AWS growth accelerates toward the 30% range again, investors can justify massive spending because they can see the revenue response, they can connect the investment to the output. That is the difference from Meta. Amazon's spending may be huge, but investors understand the logic. They see AWS. They see accelerating growth. They see advertising becoming a third major profit engine. Advertising revenue grew around 24% to more than $17 billion. This business is extremely important because Amazon sits close to purchase intent. Advertisers want to reach consumers when they are already searching for products. That makes Amazon's ad business powerful and highly profitable. So Amazon has three major engines: e-commerce at scale, AWS as the cloud and AI infrastructure profit center, advertising as a fast-growing, high-margin business. When those engines are working, Amazon can justify aggressive investment. That is why Amazon remains one of the clearest long-term growth stories in the market. The forward multiple may not be cheap in a traditional sense, but the earnings power may be understated if AWS continues accelerating and advertising continues scaling. Amazon is the kind of company that can remain a buy for a long time because it reinvests into enormous markets with clear demand and clear revenue lines. That does not mean the stock cannot fall. It can, but the long-term machine remains powerful. Now look at Google. Google delivered an even stronger statement in some ways. Revenue grew 22% year over year. Cost of revenue grew only 14%. Total costs and expenses grew 18%. Income from operations grew 30%. That means Google generated operating leverage. Revenue grew strongly, but operating income grew even faster. That is what investors want from a company at this scale. There were some unusual items that made net income and earnings per share look even stronger. So you should not blindly extrapolate every bottom line number. But the operating performance was excellent. The real reason the market accepted Google's higher capex is Google Cloud. Google Cloud revenue grew more than 60% year over year and came in far above expectations. That is an extraordinary number for a business already doing more than $20 billion in quarterly revenue. This is not a small experimental segment anymore. Google Cloud is becoming a major growth engine. So when Google raises capital spending to a very high level, investors say we understand. They can see the link: more AI infrastructure, more cloud demand, more customer growth, more revenue acceleration. Again, compare that with Meta. Google can point to Google Cloud, Amazon can point to AWS, Microsoft can point to Azure. Although the story there is a little more mixed, Meta cannot point to an equivalent line item that makes the spending feel obviously justified. That difference explains why one stock can be rewarded for capex and another punished for capex. The market does not hate spending. The market hates spending. It cannot measure. That is a principle. Now with Google, there is another issue: valuation and timing. A stock can have a great quarter and still no longer be an attractive buy if the prices move too far. The best time to buy Google may have been when fear was higher and the stock was much cheaper. After a powerful move, the stock may be more of a hold or even a trim for some investors. This is another principle. Great company and great stock are not the same at every price. Google's business is strong. Google's quarter was excellent. But the risk reward after a large move may be less attractive than it was before. That does not make the business bad. It means the easy money may already have been made in the near term. Now look at Microsoft. Microsoft's quarter was strong, but not as clean as Google's. Revenue grew 18%. Cost of revenue grew 22%, which is not ideal. But research and development grew only 9%. Sales and marketing grew 10%, and general and administrative grew 11%. Those controlled operating expense lines help preserve operating leverage. Operating income grew 20%, and net income and earnings per share grew 23%. That makes the quarter strong, not perfect, but strong. The challenge for Microsoft is that Azure growth remains in the high 30% range, which is very good, but not showing the same dramatic acceleration as AWS or Google Cloud. AWS is accelerating. Google Cloud is accelerating very strongly. Azure is still growing fast. But investors are not seeing the same kind of upside surprise. This matters because Microsoft is also spending heavily. If the company is increasing capex because of AI, memory, cloud, and infrastructure demands, investors want to see Azure acceleration. If growth stays solid but not accelerating, the market may become more cautious. Microsoft is still a great company, but the near-term stock upside may be more limited than the upside in the chip suppliers that are receiving the capex dollars. This is the important read through Meta, Amazon, Google, and Microsoft are all spending aggressively on AI and infrastructure. Some are justifying the spend better than others. But regardless of whether the spender's stock goes up or down, the money flows to the suppliers. NVIDIA, AMD, Micron, if these companies keep raising capex, the chip companies keep getting paid. That is why the chip side may remain more attractive over the next 12 to 18 months than some of the mega-cap platform companies themselves. The spenders may face margin pressure, the suppliers may see revenue growth, demand strength, pricing power, and backlog. When every major technology company is saying, we must spend more, the investor should ask who sells them the products they must buy. That is why AMD is so important in this environment. AMD may be the next major beneficiary as AI infrastructure spending broadens beyond NVIDIA, and as demand continues to exceed expectations. NVIDIA remains the dominant force, but the ecosystem is large enough that AMD can capture meaningful upside. Micron also benefits from the memory side of the cycle because AI infrastructure requires massive amounts of memory and data movement. This is why I would be more confident in the chip-related stocks over the next year or two than in some of the mega-cap spenders whose cash flow may be pressured by capex and depreciation. That does not mean the chip stocks are risk-free. They are cyclical. They can fall hard. They can get overvalued. They can be vulnerable if spending expectations slow. But when the largest buyers are increasing spend, the near-term setup remains powerful. Now contrast all of that AI capex intensity with a completely different kind of business, Cheesecake Factory. Cheesecake Factory does not need to spend $150 billion on AI chips. It serves food. That simplicity has value. The quarter was solid. Revenue grew to roughly $978 million from $927 million. Food and beverage costs improved as a percentage of revenue. Labor expense improved as a percentage of revenue. Net income grew strongly, partly because the prior year had a debt extinguishment loss that did not repeat. Earnings per share grew to $1.02 from 67 cents. It was not a perfect quarter because certain operating costs rose. But it was a strong and steady report. The attraction of Cheesecake Factory is not that it will become the next AI platform. It is that it has durable restaurant brands, expansion opportunities in North Italia and Flower Child, an established cash-generating core brand, a reasonable valuation, and dividends that can be reinvested into other opportunities. This is a different type of investment. It is not the highest growth stock. It is not a technology story. It is not a CapEx arms race. It is a stable company with a path for expansion and shareholder returns. In a portfolio that can be useful, not every investment needs to be about AI. Some investments are about steady cash generation, expansion, dividends, and a reasonable price. That brings us to the stock the market punished badly after earnings, even though the underlying report was very strong. SoFi, this is where the opportunity may be. SoFi stock fell sharply after earnings, but when I look at the income statement, I see a company growing at a very impressive rate. Total interest income grew 31% year over year. Total interest expense grew only 16%. Net interest income grew 39%. Loan origination sales, securitizations, and servicing grew 169%. Loan platform fees grew 49%. Other income grew 87%. Total non-interest income grew 49%. Total net revenue grew 43%, reaching around $1.1 billion from $771 million. Total non-interest expense grew 30%, meaning revenue grew much faster than expense income before income taxes grew 150%. Net income grew 135%. Earnings per share doubled to 12 cents from 6 cents. This is an excellent income statement. A business growing revenue more than 40% while income before tax grows 150% is showing operating leverage. It is scaling, it is becoming more profitable as it grows. That is exactly what long-term investors want to see in a growth company that is moving from promise to profitability. The market may have reacted to guidance, expectations, short-term positioning concerns about the lending cycle, technology platform weakness, or simply the fact that the stock had already moved. But the underlying numbers deserve attention. This is where the distinction between stock reaction and business performance becomes crucial. A stock down 15% after earnings does not automatically mean the business is broken. Sometimes it means expectations were too high. Sometimes it means traders wanted perfection. Sometimes it means one segment disappointed while the larger machine improved. Sometimes it means the market is giving long-term investors an opportunity. With SoFi, the member growth is very important. Members grew from 10.9 million to 14.7 million. That is a very large increase. And SoFi still has a long runway. A digital financial platform with fewer than 15 million members is not mature. If the long-term addressable market is tens of millions or even potentially 100 million plus members over time. That is why the long-term opportunity is so large. The company is building a full financial ecosystem: banking, loans, investing, stocks, crypto fees, technology platform services, member relationships, cross-selling. If SoFi can keep acquiring members, deepen relationships, sell multiple products, maintain credit discipline, and keep scaling profitably, the business can become much larger than it is today. That is why I think the market may be too focused on the short-term stock reaction and not focused enough on the long-term machine. Now, one of the most overlooked details is Galileo, the technology platform. Platform accounts had been declining for 2 consecutive quarters, falling from 160 million to 158 million, and then to 128 million. That decline was a real concern, but in this quarter, platform accounts reversed and grew to 133 million. That may not sound dramatic, but trend reversals matter. If a struggling segment stabilizes and begins to grow again, while the core business continues to scale, that can change the narrative. Galileo and the broader technology platform gives SoFi another dimension beyond consumer lending and banking. It can become both a direct-to-consumer financial company and a technology infrastructure provider. That is important because the best fintech companies are not only lenders, they are platforms. They monetize relationships, data payments, fees, accounts, and services across multiple products. This is where the next Palantir idea comes in. When people say a stock could be the next Palantir, they often mean a misunderstood company that takes years to develop, gets doubted by the market, then suddenly becomes obvious once the financials inflect. Palantir was criticized for years. Many people misunderstood the business. Then profitability, AI demand, government and commercial growth, and operating leverage changed the market's perception. The stock did not become a winner because everyone understood it from the beginning. It became a winner because the fundamentals eventually forced the market to reprice it. SoFi may have a similar kind of setup if management continues executing. It is not the same business as Palantir. The comparison is not about products. It is about market misunderstanding, long-term platform potential, operating leverage, and the possibility that a company dismissed by many investors eventually becomes too strong to ignore. SoFi is trying to become a force in consumer finance and fintech. If it succeeds, traditional banks will have to take it seriously. Wells Fargo, Bank of America, JP Morgan, and other financial institutions cannot ignore a platform that keeps growing members, improving profitability, expanding products, and attracting younger, digitally native consumers. That is the strategic threat. Traditional banks have trust, scale, deposits, and relationships. SoFi has digital experience, brand, product expansion, and potentially a much more modern consumer financial interface. If SoFi continues compounding members and products, it can take share. But this is not risk-free. Any company in banking-related services carries risk. Credit risk matters, lending quality matters, funding cost matter, regulatory risk matters, liquidity matters, economic cycles matter. If a company in this space takes on too much risk, losses can appear quickly. In extreme cases, financial companies can fail. That is why position sizing matters even when the upside is large. You cannot treat a financial company like a riskless compounder. You must respect the downside. SoFi tries to keep the business model more asset-light by selling loans, earning fees, securitizing, servicing, and acting as a middleman in certain areas. That reduces some risk relative to holding everything directly, but it does not eliminate risk. A downturn, credit stress, funding pressure, or regulatory issue can still hurt the company. This is why the investment case must include both the upside and the risk. The upside is huge. The risk is real. That is the honest framework. Now, why could SoFi become a $50 stock within 5 years or a $100 stock long term? The answer depends on execution. If SoFi continues growing members at a high rate, expands revenue per member, improves cross-sell, grows net interest income and non-interest income, stabilizes and reaccelerates the technology platform, keeps credit losses under control, and continues expanding profitability, the market will eventually have to value it differently. A company growing revenue 40% and net income triple digits cannot trade forever as if it is just a risky lender if the performance continues. The key phrase is, if the performance continues. One quarter is not enough, but the direction is compelling. SoFi's income statement shows that the business is not merely growing, it is scaling. Revenue growth is outpacing expense growth. Profit growth is much faster than revenue growth. Members are growing. Platform accounts may be stabilizing. Product expansion continues. That is the combination long-term investors look for. This is why a sharp stock decline after a strong quarter can become interesting. The market is offering a disagreement. Short-term traders say the stock should be lower. Long-term investors can ask whether the business is stronger than the stock reaction suggests. If the answer is yes, opportunity may exist. Now compare SoFi's situation with Meta. Meta has huge revenue growth, but expenses are growing too aggressively. So the question is whether the business will lose operating leverage because of CapEx and AI spending. SoFi has strong revenue growth and expenses growing slower than revenue. So the question is whether the market is underestimating operating leverage. That is an important contrast. Meta is an established giant being questioned because spending may be too high. SoFi is a growth company being punished despite improving leverage. Different situations, different risks, different opportunities. Now compare SoFi with Amazon and Google. Amazon and Google can justify heavy CapEx because cloud growth is accelerating and investors can see the line item. SoFi does not have the same AI CapEx problem. Its challenge is not whether it can justify $150 billion of spending. Its challenge is whether it can continue scaling a financial platform without taking excessive credit risk. That is a different problem. It may be more manageable if execution stays strong. Now compare SoFi with Cheesecake Factory. Cheesecake is stable, dividend-paying, and expansion-driven. SoFi is higher growth, higher risk, and more volatile. Cheesecake may compound steadily. SoFi may compound explosively if it becomes a dominant fintech platform. They serve different roles in a portfolio. A mature investor can own different types of businesses for different reasons: stability, growth, income, asymmetric upside, AI infrastructure, fintech disruption. The portfolio does not have to be one theme, but the investor must know the role each company plays. SoFi is not asleep. Well at night dividend compounder. It is a high upside fintech platform with real risk. That means it should be sized accordingly. Now let us talk about what the market may be missing. First, member growth. A platform becomes more valuable as the member base grows and products expand. If SoFi can move a member from a loan to a checking account to investing to credit card to brokerage to crypto to other financial services, lifetime value rises. Customer acquisition cost becomes more powerful when one customer can use multiple products. Second, revenue diversification. Net interest income matters, but non-interest income growing 49% is very important. Loan platform fees, origination sales, servicing, and other income create a broader revenue base. The more SoFi can diversify away from pure lending spread, the more resilient the business can become. Third, operating leverage. Revenue grew 43% while non-interest expense grew 30%. That spread matters. If it continues, earnings can grow much faster than revenue. Fourth, profitability. Net income grew 135%, EPS doubled. The market used to criticize SoFi for not being profitable enough. Now profitability is improving quickly. Fifth, Galileo stabilization. Platform accounts reversing from decline to growth may signal that a weaker area is improving. Sixth, long runway at 14.7 million members. SoFi still has room to grow. If the company can reach tens of millions more members, the scale effects can be significant. These are the bull case pillars. Now, what could go wrong? Credit can deteriorate. If borrowers weaken, losses can rise, funding costs can pressure net interest margins, the economy can slow, regulators can restrict certain products or practices, competition from banks, fintechs, brokerages, and crypto platforms can intensify. The technology platform can disappoint, member growth can slow, management can misallocate capital. The stock can remain volatile for years. These are not minor risks, they are real. But investing is not about finding risk-free upside. It is about finding situations where the potential reward justifies the risk and where the investor understands what would invalidate the thesis. For SoFi, the thesis would weaken if member growth slows materially. Credit quality deteriorates sharply, revenue growth decelerates without margin improvement, Galileo continues shrinking, or management takes balance sheet risk that investors did not expect. The thesis strengthens if member growth continues, non-interest income grows, net income scales, EPS improves, credit remains controlled, and technology platform accounts recover. That is how to monitor it, not by looking only at the daily stock move. Now, what is the lesson from all the earnings reports together? The market is becoming more selective. It is not enough to say AI and get rewarded. Meta said AI, but the market punished the spending because the return on that spending is not clear enough. Amazon said AI and cloud, and the market rewarded the spending because AWS growth accelerated. Google said AI and cloud, and the market rewarded the spending because Google Cloud revenue grew more than 60%. Microsoft said AI and cloud, but the market is more cautious because Azure growth is strong but not accelerating in the same way. Chip companies benefit because everyone else's spending becomes their revenue. Cheesecake shows that non-AI businesses can still be attractive if they grow steadily, manage costs, and return cash. SoFi shows that high-growth fintech can be punished by short-term price action even when the underlying operating leverage is powerful. That is a very important market environment. The easy part of the AI trade may be maturing in some areas, while second-order beneficiaries and mispriced growth stocks may still offer opportunity. Investors must now do more than chase headlines. They must read the income statements. They must understand which line items matter. Revenue growth alone is not enough. Operating leverage matters. CapEx justification matters. Segment acceleration matters. Expense discipline matters. Customer growth matters. Balance sheet risk matters. That is how you separate the real opportunities from the crowded trades. Now, for SoFi specifically, the question is whether the market is treating the company as if it is just another risky financial stock when the business is becoming a broader digital financial platform. If the market continues to misunderstand that, the opportunity remains. But if the company fails to execute, the market will be right to punish it. That is the tension. I would not call SoFi riskless. I would call it one of the more compelling high-growth opportunities if you are willing to accept volatility and monitor the fundamentals. A stock that can fall 15% after a strong quarter is not for weak hands. But a company growing members, revenue, and earnings at this pace should not be dismissed because of one day of price action. This is where long-term thinking matters. Most investors say they are long-term until the stock goes down. Then they become one-day traders. That is backward. If your thesis is based on 5-year member growth, product expansion, and operating leverage, then a one-day decline after earnings is only important if it changes those 5-year variables. Did the business model break? Did member growth collapse? Did credit deteriorate beyond control? Did management lose credibility? Did revenue growth disappear? If not, then the price decline may be noise or opportunity. The market is allowed to be emotional. You do not have to be. Now, the final point is portfolio construction. I would not own only SoFi. I would not own only Meta. I would not own only AMD. I would not own only Amazon. A portfolio should have multiple engines, some AI infrastructure exposure, some large platform businesses, some growth fintechs, some stable cash generating companies, some diversified index exposure, some cash reserves. The exact mix depends on the investor, but the principle is the same. Do not let excitement make you concentrated beyond your risk tolerance. The best investors survive long enough for their best ideas to work. If SoFi becomes a $50 stock or a $100 stock over time, you do not need your entire portfolio in it to benefit. A meaningful position can matter. A reckless position can destroy emotional discipline. This is why sizing is part of the thesis. A great idea sized too large can become a bad experience. A risky idea sized properly can become a powerful contributor. Now, what would I watch going forward for Meta? I would watch CapEx guidance, daily active people, operating margins, and whether management gives a clearer explanation for the AI spend. For Amazon, I would watch AWS growth, advertising growth, operating income, and whether the CapEx continues to translate into cloud acceleration. For Google, I would watch Google Cloud growth, CapEx, core search stability, and whether the stock price has already priced in much of the near-term good news. For Microsoft, I would watch Azure acceleration, capital spending, cost of revenue, and whether AI investment drives measurable incremental growth. For Cheesecake Factory, I would watch traffic, margins, expansion of North Italia and Flower Child, and dividend sustainability. For AMD, Nvidia, and Micron, I would watch the continuation of hyperscaler CapEx, AI infrastructure demand, memory pricing, and whether spending expectations remain elevated. For SoFi, I would watch member growth, net revenue growth, non-interest income, credit quality, Galileo platform accounts, operating leverage, net income, and EPS trajectory. These are the variables that matter, not whether a stock is up or down after hours, not whether commentators are euphoric or angry, the numbers, the direction, the durability. The market may be emotional today, but over time, businesses are weighed by cash flow, growth, margins, and return on capital. That is why I keep coming back to the income statement. Price tells you what people feel today. The income statement tells you what the business is doing. You need both, but you should not confuse them. Now let us close with the core lesson. Big tech earnings are revealing the next phase of the market. AI spending is massive, but the market is no longer rewarding all spend equally. It rewards spending when there is a clear line to revenue growth, like Amazon with AWS and Google with Google Cloud. It punishes spending when the return is vague, like Meta's increasingly aggressive CapEx. It gives Microsoft a more measured response because the company is strong, but Azure is not accelerating in the same way. It strengthens the case for chip suppliers because Nvidia, AMD, and Micron receive the money that others are spending. It reminds us that stable non-AI businesses like Cheesecake Factory can still be attractive when they execute and return cash. And then it gives us SoFi, a company whose stock was punished even though the business showed powerful growth, improving profitability, member expansion, and signs of platform stabilization. That is where the opportunity may be. SoFi is not risk-free. It is not a guaranteed next Palantir. It is a high-risk, high-upside fintech platform that must keep executing. But if it does execute, the market may eventually reprice it in a very different way. The stock falling after earnings does not bother me if the business is getting stronger. What would bother me is deteriorating fundamentals. Right now, the fundamentals look better than the price action suggests. That is why I would focus on the long term. In markets, the best opportunities often appear when the crowd reacts to the short-term pain and misses the longer-term machine. SoFi may be one of those moments. The task is not to get distracted by the daily chaos. The task is to identify the companies with long runways, improving economics, capable management, and the ability to compound. Then size them intelligently, monitor them honestly, and hold them long enough for the thesis to prove or disprove itself. That is how real wealth is built, not by reacting to every post-earnings move, but by understanding which businesses are becoming more valuable while the market is too busy looking at the wrong line item.